Leveraging corporate resources for your financial plan. Now, I am not a financial planner. This is my own personal financial strategy. In order to understand my financial strategy, you need to know a little bit about my philosophy on money. And in order to understand my philosophy on money, you need to know a little bit about my philosophy on life. Without diving too deep into what's the meaning of life, I'll just simply say that for me, the meaning of life is centered around the definition of life itself, and that's to live, but not just to live with passion. Everybody has their own passion. You may be a surfer and your passion is just quite simply going down to the ocean and surfing. For me, my passion is geared around trying to experience as many different things as I can while I'm alive and to do that with everything that I've got. And so you may have noticed that in a fitness class, I will tend to be right next to the instructor. And that's because I want to be at the epicenter of what's happening. If 10 people got onto a plane and we were all to go out jumping, I would want to be the first one out the door. Not, I won't push my way to the front, and take away somebody else's experience. But if everybody's looking around, by the time they looked at me, I would be out the door. And that's just kind of the way that I'm wired. And in order to do that, it breaks down into three different components. One, to live with passion, you have to be healthy, not just physically healthy, but mentally healthy as well. So I read a lot, I listen to podcasts, I meditate. To me, the body and the mind are major components of your health, and your health is uh, a significant contributor to your ability to live with passion. If you're in poor health, you're not going to be able to live with passion. If you're in really poor health, you may be struggling to live at all. So health is really important to me. There are three different components of survival as far as food, water, and shelter. But when it comes to health, the better food you eat, the cleaner water or the more water you drink, the more stable your shelter is, the better your health is going to be. Also, in order to live with passion, for me, I have to experience things. I have to get out there and interact. I can't do it from my couch. I have to get out there and go do things. And so, different types of experiences are important to me. Sometimes I need transportation to do those types of experiences. Um, and so anything within inside of these green bubbles here, I highlighted them in green because they can be enhanced with money. And so when people say that money can't buy you happiness, I disagree. I think if money is used correctly and if wealth building is done correctly, it can definitely buy you happiness. But if you're somebody out there that's just acquiring money, you're greedy, you're getting money for power, or you're getting money in a way that hurts other people, yeah, you're going to be sitting there in a $3 million home and you're not going to be happy. But if you use it correctly, it can enhance your ability to live with passion. For example, transportation. Yes, I could walk everywhere, but if I want to experience things like go to a different country, those experiences cost money. Transportation to that country costs money, so on and so forth. I do that because it gives me different perspectives. And many times after traveling, I come back and I look at something that I always viewed a particular way, and now I see it totally different, and I love that. The way that I navigate through experiences is through energy. I tend to gravitate away from things that feel negative to me. May feel good to somebody else. I'm not saying it's right or wrong. I'm just saying to me it feels negative. And I will gravitate towards experiences or people that have a very strong positive energy about them. And when I am in those situations, I also divert my own energy. And that kind of comes into that other component, and that's love. In that, when I'm in those positive experiences, I will pour my love, my positive energy into those situations, into those people, because it's a give and take. I don't want to be there just kind of sucking all the positive energy out of the experience. I want to be able to give back. I want to be able to contribute. I want to be able to heighten that experience with my own positive energy. Also, if I find myself in a negative situation, one of the best ways to diffuse it is with positive energy. So, with that, because my experiences are focused around energy, it kind of drives a little bit of my philosophy on money. Not only these green areas, but I also associate my approach with money in a positive or negative way. Not to say that money itself has energy, it's an inanimate object. I'm projecting my own feelings of positive and negative feelings with the way that I save or spend money. For example, if I go on that trip to Italy or wherever and I put it on a credit card, in the back of my mind, there's a negative component to the positive experience that I'm trying to gain by going to Italy. That negative component is I didn't save for this. It's going to cost me. It's, there's an interest associated with it. When I get back from this trip, I'm going to have to make these payments and I'm going to have to figure out how to pay off this trip that I couldn't afford. All of that negativity around that starts to divert from the positive energy of the experience itself. And that's why I tend to avoid those types of situations. I will save up and I will, make sure that I have the money for the trip and it's paid for before I go, and then I don't have to worry about it. I can truly just live with passion and get that experience as best as I can. So, in order to be able to build your financial wealth, in order to be able to leverage what Qualcomm has for you, you have to get to a certain base level of financial stability. Now, I don't know what your personal financial situation is, but I'm just going to explain this from kind of the progressive steps. And so if somebody were to have a bunch of debt, they have a bunch of credit cards, they have a car that isn't paid for, they're in a house that's too big for their means, that type of stuff, you have to work your way out to a particular point in order for you to be able to invest effectively. And once you get to that point where you can invest effectively, large corporations like Qualcomm can really expedite your financial wealth. And that's the purpose of this, is to try and explain how to leverage those resources for you. So I've kind of stumbled my way through figuring out what is now encapsulated in Dave Ramsey's financial program. It's called Financial Peace University. I wish I had that when I was younger. I kind of figured out these steps on my own, and it took me a long time to do it. And if I had had it at the beginning of my financial journey, things would have gone a lot smoother. And so basically what he does is he breaks apart your financial wealth building into 7 easy steps that you just follow. And the first step is, again, if you have a lot of debt about you, what you want to do is build up $1,000 and just set it aside. Don't touch it. This is your starter emergency fund. It's not enough to truly pull you out of most emergencies, but it's enough to give you some breathing room so that as you work on decreasing that debt, you're not getting derailed by simple things like a flat tire or something like that. Okay, so you build up your $1,000 for your starter emergency fund. Then you really start to attack that debt. Everything but your house, especially in California, home prices are rather high, and there is a strategy on, leveraging the interest for tax purposes and paying that down within 15 years with the type of loan that you have. But for now, what you would do if you have other debt like credit cards or a car loan is you want to stack all of that debt in highest to lowest order. So maybe you have an expensive car and that's your largest loan that you have. And then you have a credit card that's for a little bit less, and so on and so forth, all the way down to the $10 that you borrowed from your brother or whatever. So you stack that in order of highest to lowest and you start attacking the lowest one first. You pour all of your financial resources to knocking that debt, that small debt, out as fast as you can. And the reason you do that is because you have your own financial resources that you're pouring at it. It may be minimal at that point because you have so much debt to deal with. But once you knock out that first one, you now have your financial resources plus what you were paying in just for the privilege of that debt, basically interest rates, right? And now you combine those two sets of money into attacking the next lowest one, and so on and so forth. And pretty soon, by the time you work up into the larger loans that you have more and more financial power behind you, because what you would have paid into those 4 or 5 or however many smaller loans, you're now taking all of that money that you were throwing towards those loans and throwing it towards the bigger debt. It's a fast way of getting out of debt, and just kind of creates this snowball, and that's why it's called the debt snowball. Once all of your debt is paid off, then you want to take that $1,000 and increase it into your ability to cover at least 3 to 6 months of your expenses. And kind of your philosophy on risk and everything kind of dictates on whether you feel more comfortable at 3 or whether you feel more comfortable at 6. But it's basically your risk profile and how big that is, but at least 3. Once you have at least 3 months worth of expenses, now if something happens, you get injured or you get laid off, or you know instead of a flat tire, your transmission goes, or the engine block drops, whatever, you have the ability to think, to slow down, to plan, to attack the problem without panicking, without derailing your financial wealth building. And that's the purpose of your emergency fund. So you build your emergency fund, again, you set it aside, you don't touch it, and it's always there available for you. Once you've done that, you are now ready to invest. And Qualcomm has a lot of stuff that is available to you in order to help you invest. But it took me a while to figure out, with all of these different financial, opportunities, what do you do first, and in what order, and how much, and all of that other stuff. And so that's what I'll lay out here in the future slides. So you first take your household income. If you're living by yourself, it would just be your income. But if you have other people living with you, you take your total house income, say, okay, 15% of that income is going to go towards the investment for the sole purpose of retirement. Okay, that's not to save up for cars, that's not to save up for trips, that's purely for retirement. If you then want to save up for cars and you want to save up for trips and doing whatever, again, it kind of depends on your passion. If you're a surfer and all you need is a surfboard and you can walk to the beach, you don't have a lot of things that you need to save up for. You just need to get down to the beach. For me, I want to be able to travel and that type of stuff. So I do save beyond, my retirement savings. But in the beginning, 15% just for your retirement. Once that's done, your next goal to save for is your children's college fund. The biggest gift you can give a child is the ability to go through college without any debt. And it's expensive. You want to estimate about $50,000 per year per child. So a 4-year education is going to be $200K per child. Now, you may not have any children yet. You may never have children, but you need to think about, okay, could I potentially have children? If so, how many do I want? Let's assume, the average is most people kind of look around that 2-child mark. You want to save for 2 children's college fund. That's $400K that you need to save for before you get to the next step. Okay, so you're still saving 15% for your retirement. Beyond that, you're saving 400K for the college fund. And then once you've had that college fund built up, you're now ready to tackle paying off your home early. Now, here's a point about the college fund. Let's say you do plan for 2 children and you never end up having children. Well, guess what? Now you have 400K to devote towards other financial goals. This is where Dave Ramsey and I differ a little bit. He comes from a real estate background and he's very risk adverse when it comes to a home. To him, it's like, so long as I have the security of a place to live, the world can fall down around me and I'll still be okay. I have a place to live. I know I can at least earn enough money to eat for the month and to pay the electricity for the month. So it's a security blanket for him. By the time I got to this stage, I had enough financial vehicles in place that, if the whole world fell around me, I could take those financial vehicles and redirect them and pay off the house. Now, typically you can't take retirement investments there. But I feel okay that my house is not paid off yet. I have a plan for it. I have a backup plan for it as well. And if for some reason, my primary plan of paying it off by the time the loan is done falls through, I can pay it off. So I'm not too worried about it. But he will tell you differently. He'll tell you no matter what, before you start increasing that 15% towards your retirement, you want to pay off your home. And then the last one is, okay, you're setting aside 15% for your retirement. You have enough in your children's college fund to pay for their colleges. You've paid off your home. You're in a good position. Now, all the money that you make that doesn't go towards your passion or your base level of living, you can start throwing that at just pure wealth building. Again, my philosophy on money is I've done that step a little bit early, and I'm throwing everything that I can, except for a minimal amount that I use to kind of chase experiences, towards wealth building. Once you hit your retirement number, and we'll talk about how you calculate that and exactly what it is here in a second, then you want to give back. Bill Gates, perfect example of this. He built a fortune and he has more money than he'll need to retire. And he's now devoting a lot of those funds and any future funds he makes towards giving back, saving, or I should say, eradicating polio. He's invested a lot of money in third countries trying to get their waste management system under control, which has a lot to do with kind of this cascading series of events. But anyways, that's where you have true power. Again, Dave and I differ a little bit on this. He is a strong believer of you start giving money, whatever you can, as soon as you can. So as soon as you're out of debt, you start giving money back. I think there are more important things than money. Again, love. That's my own philosophy to give back. And when you get to a point where you have your retirement number and you have extra, you have so much money at that point that you can really leverage that money to do very powerful things. So I think love is more important than money until you get to a very large sum of money that you can make movements with. If you haven't gotten to at least step 4, I would strongly recommend you take Financial Peace University. There are podcasts that are free that you can listen to. You can go online. You can kind of research these steps for free. You don't actually have to pay for the course, but it is a pretty good course. I will say that I've had some friends that have taken this course and they come from a different religious background than Dave Ramsey. I personally, and this is, again, kind of my own philosophy, I am very spiritual, but I'm not religious. So I respect all religions of the world, and it doesn't really bother me that he is a strong Christian, and so sometimes he has Christian messages coming through his teachings. That's fine, doesn't bother me. But I will say that if that type of stuff bothers you, just be prepared. It's still a very good financial course, and whatever, take it for what it's worth. Okay, so let's assume that you're at step 4. Now, where do I go? You first have to answer the question of what is retirement? Retirement is not an age. A lot of people that I talk to, when I ask them this question, they say, 55. And that's kind of something that marketing people planted in us way back when, actually in our parents' generation, that as soon as you hit a certain age, you're retired. And it comes from kind of that pension mentality. We don't have pensions anymore. We have 401ks. It's up to you to do your own retirement wealth building. And so retirement isn't an age, it's a number. So how do you calculate that number? Well, first of all, you kind of have to know the potential of growth of your wealth to be able to predict how it could potentially grow in the future. So if you take a look at the past as an indicator, and you take a look at the S&P 500, the S&P 500 is a collection of the top 500 companies in the US. And from the inception to last year, its growth rate is approximately 10%. Now, some years it'll be higher, some years it'll be negative, but over the years, it averages out to 10%. If you want to take that number and be a little bit conservative, you can drop that down to like 7%. And so you have to ask, how much money in investments would you need sitting out there earning you 10 or 7% a year that will return you enough in that 7% that it'll meet your future annual income needs? Now that raises the question of, what is my future annual income needs? In order to figure that out, you need to do a budget. You need to do a budget anyway to understand where you're at, what debt you have to knock out if you have any debt, how much money you can throw at debt, financial wealth building, whatever. And I would recommend that in the beginning, if you haven't built up a lot of wealth already, to really focus on need versus want. Build your budget off of need, and then take a look at how much money you have to invest. If that money that you have to invest is more than enough, then you can kind of pull back your wants and say, okay, well, my need, in order to live, I have to have rent, I have to have food, I have to have electricity, whatever. This is the base need that I have to have in my budget. but I have enough that I can throw at my investments, and I'll tell you how to calculate how many years you need to invest in order to hit your retirement number. That I can pull apart, I can take away some of that investment money and devote it towards my passion, my wants. Once you have your budget and you know how much it costs you to live, you need to think about, okay, how do I want to live in the future in my retirement? My house will be paid off. I won't have certain expenses that I have today, but I may have other expenses. I may need to plan a little bit for healthcare. May need to plan a little bit for this, that, and the other. I may want to travel more. May want to whatever. However you want to live your retirement, you think about that and you calculate how much it would cost you to live in that way. And that's your retirement goal. Your retirement goal is to build up enough in investments that 7% gained on that investment in a year would give you that number to live. Also understand that your ability to contribute to your investments will change as you start to build more and more wealth. Other opportunities will come up. You may have a very entrepreneurial mindset where you're always thinking about multiple lines of revenue stream, that type of stuff. So don't panic if your number is a little bit low in the beginning. It's okay. You throw everything you have at it, you go as hard as you can, and just know that other opportunities will come along the way to increase your ability to contribute. So just for an example, I said, okay, let's assume we need $200,000 a year in order to live the way that we want to in retirement. That number is very personal. You could have 50,000, you can have, a million, whatever it is, depending upon how you want to live, but I just assumed 200,000. You also need to assume a certain tax rate. As you're getting that 7% on your investments and you pull that money out, that's taxable, that's income. So you're going to pay income tax, and you have to assume what the tax rate on income tax will be whenever you retire. And that's a total guess. Even between the year before and last year, the tax laws changed significantly. So I just used 25% as a rough estimate. Again, we're assuming a 7% growth rate. So if I needed 200,000 and I was assuming that 25% tax rate, and I was assuming every year my total investments are at 7% is going to give me that 200,000. You can calculate. And so I gave the calculation there. It's basically your retirement divided by the combined growth minus the growth times the tax rate. And we find out that you need $3.8 million in order to get 7% on that 3.8 that will give you $200,000 after taxes. So that's your number. That's your retirement number that you need to plan for. Now that you know that, and you know by doing your budget how much money you can contribute a year to work on hitting that 3.8 million, you can calculate how many years it's going to take for you to get there. Okay, you take however much you currently have invested, which, I just threw 250,000 in there just as an example, but let's say you have $0, $2 million. I don't know. Again, that's kind of personal, but however much money you have saved, that's your starting point. You know how much you can contribute annually based upon your needs budget, and you can calculate how many years it's going to take for you contributing that much year over year with a 7% assumed growth rate to hit 3.8 million. And in this case, it'll take 20 years from now in order to hit that 3.8 million. I threw up the calculate. I don't know if you use Excel or not, but there's a formula in Excel that calculates this for you. It's called the future value formula, FV. So I threw that up here just for your reference. Okay, so now you know how much to invest, how best to invest it. So all of that background just to get to the point of, okay, how can Qualcomm help me get there? There's a lot of different vehicles that Qualcomm offers, and even those vehicles have many different layers to them. And it's a matter of knowing how to use those in order to best leverage the resources you have available to you. So first of all, you want to max out the 401k. That's your first priority. Once you're maxing out your 401k, you then want to max out the employee stock purchase plan. They call it ESPP, but it stands for Employee Stock Purchase Plan. Once you have that maxed out, you want to take any additional dollars that you have to contribute to your wealth building every year and max out your after-tax 401k. So you have a pre-tax 401k that has an IRS limit of 19,000 according to last year's financial tax code. And then after that, you invest in your employee stock purchase plan. The IRS only allows you to contribute 25,000 a year based on last year's tax code. And then beyond that, you need to take your investment dollars and go into after tax, which you can contribute up to 56,000 in after tax. Qualcomm has a special after tax capability though that's awesome, and I'll explain that in a second. Once you've done all of that, so you've maxed out your pre-tax, you maxed out ESPP, you maxed out your 401k, then you want to devote all of your money towards what's called electronic traded funds. So first thing is 401k. Qualcomm's 401k is with Fidelity, and there's a couple different components to it. First of all is your pre-tax contribution. Your pre-tax contribution pulls from your checking account before taxes. That's huge. So you're saving all of that money and you're lowering your tax burden, because now instead of making X dollars, you're making X minus Y, and it's the X minus Y that gets taxed by the IRS. So you're saving kind of on both ends, right? And you don't pay on any taxes until you withdraw the money, and then you pay only on the money when you withdraw it. So the other thing is you have a post-tax contribution. There's two different kinds. There's a post-tax Roth contribution, which again, it has a limit of 19,000, but don't worry about that. There's a better thing out there called a traditional after tax, and then you do a Roth in-plan conversion. Not a lot of companies have this. It has to be a pretty big company in order to have this feature in their 401k plan. What it does is I contribute to my pre-tax, and Qualcomm will match my contributions in pre-tax. And so let's say I max out my pre-tax, which is 19,000. So out of that money that I had in our example, we were contributing 70,000 a year. So out of that 70,000, 19,000 of it went to my pre-tax 401k contribution. Qualcomm then matched me an additional $5,575. So instead of only contributing 19,000, I contributed 24,575. Let's call it 25,000. For the cost of 19,000 pre-tax dollars. That's where companies like Qualcomm start expediting your ability to build wealth. They're giving you free money. That's a 30% gain for just investing in your retirement. So once that's done and you max out your ESPP, and then you come back to your 401k and you start contributing to your traditional after tax, which has a limit of 56,000, you take that after tax contribution, which again, it's after tax, so you pay tax on the principal. But because you can roll it over to a Roth in-plan conversion, what that means is any of the gains that I get on that, which is normally taxed, right? If I went out there and bought a stock, and not only did I buy that stock with after-tax dollars, but any gains that I get on that stock, let's say that stock went from $10 to $20. That, give me a different example. I get from $15 to $20. That extra $5 in gains, I have to pay taxes on. But with this, when I roll it over to an in-plan Roth, I pay no taxes on the gain, so long as I don't pull that money out of my 401k until after the age of, I think it's 59 and a half. And it's been at least 5 years since I made my last contribution. That's huge. Think about how much money you're going to get in all of the gains that you make in 20 years in your 401k, and you pay taxes on none of it. That's incredible. So here I kind of outlined in tabular form the different types of plans, but the important thing to note is that your pre-tax, you do have a limit of 19,000 a year. It comes out of your paycheck before taxes are applied to your paycheck, so your tax liability at the end of the year when you pay taxes is lower, and that money is working for you. And Qualcomm matches that money that you invest up to $5,575, 30% gain. And with all of that money that you end up putting into your 401k, the next question that I had to figure out was, how do I invest it in the 401k? There's several different financial vehicles within the 401k. All of these different funds that you can put your money into. The easy way of doing it is, now that you know that it's going to take 20 years to retire, they have retirement funds targeted for a specific year, and they're structured such that at the beginning of that fund, today, it's more risk. And then as you get closer and closer to the actual fund date, your retirement date, it starts shifting the balance of those funds into less risky type financial vehicles, so that by the time you actually retire, your funds are in a place that is pretty secure. Now there's always risk, but it's much less risky than like if you were in emerging markets or something like that. Or you can balance your 401k in a way that I'll show you at the end of this presentation. It takes a little bit more work, but you have more control. So the employee stock purchase plan is through E-Trade, which is through, maybe you do have the ability to do it through Fidelity as well, but mine is through E-Trade. And what the employee stock purchase plan is that it gives you the ability to buy Qualcomm stock at a minimum of 15% discount. Again, the average Standard & Poor gain is 10%. Right off the bat, you're beating the market. 15% is a good return. You do have up to a max of $25,000 that you can contribute to the ESPP. You're eligible if at the beginning of the offering period you've been employed for at least 30 days. So you can't do this until you've been here for at least a month. And you work more than 20 hours a week, which you work 30 hours a week, so you're good. And you are a full-time employee, meaning that you're not just here for a short term. You're here for until you leave Qualcomm. So you work more than, or there's a plan for you to work more than 5 months per year. Now, there are 2 offering periods. So every 6 months, you have the ability to buy in, to specify how much I want to purchase an ESPP. And so let's take, for example, the first offering period. There's 2 dates in an offering period, the beginning of the period and the end of that period. And the way that they calculate the 15% discount is they take the stock price at the beginning of the period and the stock price at the end of the period. And whichever stock price was lower, they use that amount and give you 15% additional discount on that. And that's why I say at a minimum 15%, because let's say we're at the end of the period and we happen to be at a lower point in the stock price. Well, it's just 15% off the current price, right? But let's say that at the beginning of the period, the stock was $10, and at the end of the period, it was $20. Well, they're going to sell it to you at the $10 price minus 15% of that. And then you have the gains on top of that as far as today's stock price. Now, here's the thing, though, is that if you were to turn around and sell it, which if you had a wide margin like that's 115% gain. If you had a wide margin like that, you may want to consider selling right away, because you are going to pay higher in taxes because it's a short-term sell. But it's such a huge gain that it might be good just to sell it and then go invest in something else. Then again, if it's going at that rate, you may think that, oh, it's going to continue to go up. It's, again, kind of a personal call. I personally don't worry about any of that. I buy the ESPP and I hold it for 2 years. The reason that I hold it for 2 years is because then once you're 2 years in a day, you're now into long-term tax rates. So you're taxed significantly less on the gains that you make. I sell it and then I use that money to either offset my income to increase my ability to contribute to other things, or I use it to buy ETFs. And so I'm at the point now in my wealth management where I have enough that I will max everything else out. And so the ESPP money just goes straight into ETFs. And you want to do that because you don't want to have all of your money sitting in Qualcomm. And, let's say that for some reason, Qualcomm had a downturn, laid everybody off, and now not only did you lose your job, but your stock is worthless, right? So you don't want to have so much in one breadbasket. You want to get diversified. And so pull that out, pull it into ETFs. I'll talk about how in a second, but that will diversify your money and make it safe for you, safer. Okay, so we talked about the tax offset between short-term and long-term gains. Okay, so now we're into ETFs. ETFs are electronically traded funds. The thing about ETFs is that a lot of people have different financial strategies, and they will talk about the way that they feel it's best to invest. Particularly when I started working at Qualcomm, for some reason, like people just came out of the woodwork as far as financial advisors. And I had financial advisors approaching me from insurance companies. I had financial advisors that were independent, whatever, and they were trying to sell me every single financial vehicle under the sun. And again, they take their fees and commissions for those sales, and that's how they make their money, right? But think of it this way, and even personally, like there was a while there where I was really into the market. There was a while that I was coding automated bots for Forex and trying to basically automatically beat the market. But at the end of the day, what I found out was it's gambling. It really is. I don't care how good you are, you're gambling, and the odds, even if you're the best in the world, are far worse than Vegas. And this is why. Only 8% of the world's professional money managers, so the best in the world in the stock market, have ever beat the market more than 3 years in a row. That means that they cannot consistently beat the market. There's going to be times when they lose or more than what the market on average returned. Of those 8%, only one person ever has beat the market for more than 10 consecutive years. Now we're talking about, in our scenario, we need to invest for 20 years for retirement, right? So there is only one person in the world that has ever done that for more than 10 years. Actually, he only did it for 10 years, 10 years consecutively. That's Peter Lynch. And he readily admits it was luck. He just happened to be in the right time, investing in the right things, and it just kind of, he just got lucky. If he was to use his same strategy, and he has used his same strategy, he is not able to repeat that. And, again, he's one of that 8%, but even still. So, even if you had the financial means to hire one of those people in the 8%, they're still not going to beat the market. You have to remember that. And so you have a very, very low chance of ever beating the market yourself. You have a very low chance of paying someone who can beat the market, especially 20 years. You need to invest for 20 years in order to hit the retirement based on our scenario. But a very high chance of making less than the market average. And so when you think about 8%, what is it? Roulette in Vegas has no craps. Craps in Vegas has the best odds. And even that I think is like 43 or 47%. It's pretty darn high compared to 8%. Imagine if you went to Vegas and you only had 8% chance of winning when you put your money in there. There's no way you would do it. And so don't do it with the market. The way to get around that is not to get suckered into all of these different financial vehicles that people will approach you with. Mutual funds, they're like, oh, look at the return on the mutual fund. It's beating the market every year for the last 10 years. Well, what they're not highlighting is the taxes and the fees that you're going to pay on those funds are going to drop you below the market average. Stocks, again, going out and trying to trade stocks yourself and bonds yourself, or trying to hire somebody to do it, very low chance that you'll beat the market consistently. Different insurance companies will come to you and say, hey, we created this annuity or this insurance investment vehicle that's way better than the stock market, and you buy into this insurance, and you now have a better return. Again, don't do that. If you work through the math, it's not a better return than the market, and you end up buying insurance that you don't need. That's another thing we didn't really talk about in is insurance, and basically you want to only have the minimum insurance that you need until you can self-insure. And so now Kelly and I are at the point where we can self-insure. We don't need a bunch of insurance, but just we can talk about that later on another day, kind of a different topic. But anyways, stay away from the different investment vehicles. Stick with something that is going to return the market average consistently And that's the market. You can invest in the market with electronic traded funds and their indexes that match exactly to the market. Okay, so how do you do that? There's a guy out there called Ray Dalio. He is one of that 8%. And the way that he invests to get that 8% is he pays attention to a lot of different indicators in the market. Basically, he takes a look at inflation, he takes a look at the GDP in order to see if the country's growth is accelerating or decelerating. He takes a look at all these different financial reports, the jobs reports, the housing reports, all of these different things. And what he tries to do is he says, okay, if you take a look in that upper right-hand corner of that graph there, let's assume the GDP is accelerating slightly and it's slightly rising inflation. He's going to be heavily invested in inflation-protected bonds. But then you have to be an expert on inflation-protected bonds in order to know which ones to purchase. And same thing, let's say you have high GDP and high inflation. So again, you're in that upper right-hand corner. You would be investing most heavily in emerging equities. But again, you need to know which emerging equities, and he's a master at it. And that's why he's in that 8% that can, around 3 years or so in a row, he can beat the market, but then he's going to come in under the market. And those losses just kind of depend the offset of how much he gained. When he was asked, how would you teach your children to invest? He's like, I wouldn't teach them that strategy. It's way too complex. It requires somebody to spend their life in this stuff with passion. So unless you really want to be the next Ray Dalio and it just, gets you going to, regardless of the amount of return that you get, you're just happy because you're using this strategy, then go for it. But the way that he would teach his children is he would diversify in different asset classes, like 18.75 in stocks, 20.83 in inflation linked bonds, so on and so forth, to where when the stock market is high, you have a lot of return in the stock market and you rebalance every year. And then when it's low, you end up rebalancing every year. And what that effectively does is if you stick to that certain percent allocation, let's say you're in a year where the stock market did awesome. Well, at the end of the year, because the stock market did awesome, you're going to have more than 18.75% of your wealth in stocks because it grew so much. So you're not overweighted on stocks. And so you take the amount that you're overweighted to get it back down to 18.75, and you take that money and you invest it in the things that didn't do well to get them back up to the percentage that you need. So you're balanced again. This takes about, I would say about 4 hours once a year, as opposed to devoting your life to learning the financial markets of the world and staying on top of changes and all that. It takes about 4 hours a year. And what it does is beautiful in the sense that you're selling high and buying low. So going back to our scenario again, stocks are doing awesome. So the stocks that you have are high priced now because they've gained so much in value. So you're selling them when they're high, and then you're buying everything else on sale because they did so crappy over the last year. They're now really cheap, and you can buy a lot of them. And that's Warren Buffett's strategy. I don't know if you know who Warren Buffett is, but again, one of those 8%. And he basically says that, the holy grail is being able to sell high and buy low. And this forces you to do that in a balanced way that no matter what's going on in the market outside of total financial collapse of a particular country, right? But no matter what's going on in the market, you're having highs and you're having lows and you just redistribute. So you're always selling high and buying low. Now I went through and I took a look at different ETFs because different ETFs have different fees. And so if you look at the upper right-hand corner of that image that just showed up there, you see that SPDW, which is basically an index that tracks the non-US equity market. Its fees is only 0.04%. That's extremely low. Like a lot of mutual funds, their fees are around 1 to 2%. So instead of paying $2, you're paying 4 cents to have this. And that 0.04 again is eating away at your 7% goal of return. 10% is again the average for the market in this particular one. But so if you were to try and get something that on your own was matching the market, and you're trying to hit that 10% return of the S&P 500, but you're paying 2% in fees, it could be doing 12%, and you're thinking, oh, great, it's beating the market, but you just paid 2% in fees. There's also taxes that have to hit a mutual fund every year that also eat away at that. And so that's why ETFs are so good, because you manage them yourself. You don't have to pay anybody to buy these for you. They're available out there on E-Trade or whatever financial tool you use in order to buy and sell stuff. And what I did was I balanced across the different asset classes. Like there are ETF funds that track to real estate. So rather than going out and buying a house and hoping that the equity curve goes up and that you sell high, again, kind of a guess, you don't have to. You just buy the ETF and it tracks to the real estate market. And so I have non-US equity, small cap equity, large cap equity. I mean, you could kind of read down the list here, but it's basically every major investment class in the US market. I even have non-US fixed income bonds and emerging market equities, which could be out of the US. So international funds as well. And I went through and I looked at their fees and I looked at their performance over the last 10 years and said, if I started with initial investment of $10,000, where would I be at the end of those 10 years had I invested 10 years ago at this percent allocation that I have in the upper left-hand corner? So 17% in US and non-US equity, 16% in small cap equity, so on and so forth. And it would have returned 13%. That's with all of the fees baked in. Now that's 2020's hindsight, right? I'm taking a look at how things performed over the last year and said, oh yeah, well, if I was balanced that way with these ETFs, I would have been at 13%. But what you do is every, I would say about 3 years or so, you go back to make sure that your percent allocation is still in alignment. It doesn't change significantly, but you still make sure that you want 17% instead of 15% in non-US equity by using this. And all you have to do, which takes maybe an hour to go and come up with this chart. So you spend an hour there every 3 years, but for most years, all you're doing is you're just selling what is, let's say, like, again, the stock market did really high. And so instead of at 17%, I'm at 25% allocation. I sell to get me back down to 17%. And I take the proceeds from that sale to rebalance to buy things that are currently on sale. So that's how I balance my portfolio. That's how, when I sell my ESPP or any other investment dollars that I have beyond ESPP and traditional after-tax 401k and 401k, this is how I buy ETFs. So that's the strategy. That's how you use Qualcomm's 401k. That's how you use the different types of investment choices within the 401k, between the pre-tax and the after-tax with the in-plan conversion, as well as how you allocate your funds inside that 401k. Took me a while to figure that out. And then, there was a while there where I was kind of, before I ended up building up a certain point in my wealth, where I wasn't maxing out the 401k. And so I was trying to say, oh, well, maybe I should invest a little bit of money in the 401k and invest a little bit of money in ESPP and all that. Don't do that. Use the process that I outlined as far as the priority, and mathematically you will far exceed just kind of randomly investing in different investment vehicles with Qualcomm. So all that being said, this may be a lot, or you may be very comfortable in this space, but if you're finding that this was a lot of information in the last, I don't know, hour or however long that took, just know you're not alone. I'm here. I can help answer questions. Feel free to talk to me if you want to go over anything again, or if you want help sitting down with budgets or doing calculations for your retirement number, whatever, I can help you with that. But hopefully this puts everything into kind of perspective on how you should be leveraging Qualcomm and what they have available to you in order to make sure that you are building your wealth as fast as possible.